य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुभ्रं तदेव शुभ्रदब्रह्मा तदब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः श्रितः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Dear viewer, this presentation has been brought to you by the Ethical Standards Board to let you know about the several changes made in the Code of Ethics by the ICAI. Enacted in accordance with the Chartered Accountants Act 1949, ICAI is the second largest accounting body in the world. With the motto of excellence, independence and integrity, ICAI has become a catalyst of socio-economic reform of the Indian economy in the last 71 years since its inception. The Ethical Standards Board of ICAI is set to function as a standard-setting body that develops and issues ethical standards and other pronouncements for chartered accountants. Keeping up with the changing times, the Code of Ethics has been revised recently. In this video, which is not intended to be a comprehensive guide, we will go through the significant changes made, all the while expecting the members to read the actual book to know and comply with the changes made. As you all are aware that the Code of Ethics 2009 consisted of two parts, Part A and Part B. It was valid till 30th of June 2020. While Part A was based on the International Ethical Standard Board for Accountants known as ISBA Code, and Part B was based on the domestic provisions that govern the members, the revised Code of Ethics consists of Volume 1 as a revised counterpart of Part A and Volume 2 as a revised counterpart of Part B. Both the volumes have been effective since 1st July 2020. Furthermore, Volume 3 of the Code of Ethics deals with updated related disciplinary case laws, and all the three volumes are available at www.icai.org. Please note that certain provisions of the revised Code of Ethics have been deferred till further notification in the wake of the COVID-19 situation. These provisions are as visible on your screen. They are responding to non-compliance of laws and regulations (NOCLAR), fees and relative size, and taxation services to the audit clients. All the other provisions have been applicable since 1st July 2020. This is the 12th edition of the Code of Ethics and for the first time has been segregated in different volumes. As informed already, the Code of Ethics has been divided into three volumes, Volume 1, Volume 2 and Volume 3, which have been in effect since 1st July 2020. The members are expected to know that ignorance, lack of adoption or implementation of the code will be considered as a professional misconduct. The e-code to help you understand the provisions consistently is available on the digital learning platform of ICAI. Further, various awareness programs are being conducted for the same. Let us begin with the Volume 1 of the new Code of Ethics based on the ISBA Code. Let's give a quick glance at the 5 most important substantive changes in the Volume 1 before delving into the details. Please note that the provisions of responding to non-compliance of laws and regulations, the NOCLAR, has been made which was not there in the Code of Ethics 2009. There being none earlier, the code now has certain restrictions on the taxation services provided to the audit clients. Now there is a prohibition on the management's responsibilities to the audit clients. Another change is the restriction of fee from a single client. The earlier edition had a provision on self-regulatory measures which put 40% restriction on the fees from an audit client with certain exceptions. The new code puts this restriction at 15% from a single client if it's consecutively for 2 years. If the condition is not fulfilled, the firm will be under the duty to communicate this fact to those charged with governance. The fifth important change is that the duty of the accountant has been mentioned in case of breach of independence standards, where nobody except the member knows that there has been a breach on his part. There was no such corresponding provision in the earlier code. The 5 most important structural changes made in the Volume 1 are as follows. In the Revised Code of Ethics, Volume 1, independence requirements for audit and review engagements and other assurance engagements have been differentiated, which were clubbed in the Section 290 of the earlier Code of Ethics. For the first time, independence sections have been recharacterized as international independence standards. Making various compliances mandatory, at several places, the word should have been replaced with the word shall. In the Revised Code of Ethics, there is a new pattern of structuring of sections, which is not there earlier. There is an increased clarity of responsibility for compliance for firms, network firms, individuals within the firms in the Revised Code. The term professional accountant, which was adopted from the ISBA code, has been referred to as PA in the presentation. An individual who is a member of the Institute of Chartered Accountants of India is a professional accountant. ISBA Code of Ethics uses the term professional accountants in business, implying the members who are employees. While incorporation in the ICAI Code of Ethics, it has been modified to professional accountants in service in our code, in line with the usage in the Chartered Accountants Act 1949, which mentions members in employments as members in service. Let's see the overview of the structure of the Code of Ethics 2009. The Part A was based on the IFAC ISBA Code of Ethics 2005 edition. It contained Chapter 1, which had the general application of the code, Chapter 2, applicable on the professional accountants in public practice, and Chapter number 3, applicable to the professional accountants in service. Coming to the Part B, based on the domestic Indian provisions, the Chapter 4 contained accounting and auditing standards. Chapter 5 contained the Chartered Accountants Act 1949. The Chapter 6 contained the Council guidelines. Chapter 7 contained the various self-regulatory measures recommended by the Council. Even though recommendatory in nature, the Council earnestly believed that the implementation of these measures would go a long way in ensuring equitable flow of work among the members and would further enhance the prestige of the profession in the society. The Part B also contained appendices A to F. Let's now see the overview of the structure of the Revised Code of Ethics. The Part 1, which is applicable to all professional accountants, is complying with the code, fundamental principles, and conceptual framework. Part 2 pertains to the provisions applicable to the professional accountants in service. Part 3 pertains to the provisions applicable to the professional accountants in public practice. The code also contains international independent standards, Parts 4A and 4B. Part 4A consists of independence for audit and reviews from Section 400 to 899. Part B consists of independence for other assurance engagements from Section 900 to 999. The code contains a glossary of terms used in the Code of Ethics applicable to all professional accountants, whether in practice or in service. Let's see the fundamental principles applicable to all the members. Starting with integrity, which means that a chartered accountant should be straightforward and honest in all professional and business relationships. Associating with the information which they believe is false or misleading by any fraction is one of the several acts that harm one's integrity. Objectivity, which refers to an unbiased frame of mind while taking a professional decision, is an essential trait of a chartered accountant. One shouldn't compromise professional or business judgment because of bias, conflict of interest, and undue influence of others. The third is professional competence and due care. It says about attaining and maintaining professional knowledge and skill at the level required to ensure that a client or employing organization receives competent professional service based on the current technical and professional standards and relevant legislation, and acting diligently and in accordance with the applicable technical and professional standards. For example, a chartered accountant in practice should perform the audit in accordance with the standards on auditing issued by the ICAI and the relevant laws applicable to the client. The fourth is confidentiality. Both the members in practice and members in service are expected to maintain and respect the confidentiality of professional and business relationships. The Clause 1 of Part 1 of the second schedule to the Chartered Accountants Act 1949 prohibits a member in practice from disclosing any information gathered in the course of their chartered engagement to any person other than the client engaging him. Only when he has the client's consent or any law in force requires him to do so, he can disclose the information. Lastly, professional behavior. A chartered accountant should comply with all the relevant laws and regulations to avoid any action that might discredit the profession. Section 120 of the Volume 1 of the Revised Code of Ethics discusses a conceptual framework to assist a chartered accountant in identifying, evaluating, and addressing the possible threats to the compliance with the fundamental principles, which may arise sometimes due to the circumstances in which the chartered accountants operate. If the identified threats are other than clearly insignificant, a chartered accountant should apply safeguards to eliminate those threats or at least reduce them to an acceptably low level, such that the compliance with the fundamental principles is not compromised. If it is not possible to reduce the threat, the assignment must be declined. Looking at the provisions for enforcing the compliance of the code, the Part A of ICAI Code of Ethics 2009 was issued as a guideline of the Council. The Code of Ethics 2009 Volume 1 is also issued as a guideline of the Council. As a result, the non-compliance of the provisions of the Code will be deemed as a violation of Clause 1 of Part 2 to the second schedule of the Chartered Accountants Act 1949. Which states that a member of the institute, whether in practice or not, shall be deemed to be guilty of professional misconduct if he contravenes any provisions of the Act or the regulations made thereunder or any guidelines issued by the Council. The non-compliance of the provisions of Volume 1 will result in the liability under the disciplinary mechanism of the institute. As noted earlier, this is also relevant to note that there is a change in the drafting from the word should to the word shall, and the requirements are clearly demarcated, making compliances mandatory. Each section of the Volume 1 of the Revised Code of Ethics have been structured wherever appropriate in the following manner. First, the introduction. It would set out the subject matter addressed and introduce the requirements and application material in the context of the conceptual framework. Second, requirements. This has been designated by the letter R. This section includes the word shall, which imposes an obligation on PA to comply. The requirements contain general and specific obligations with respect to the subject matter addressed. Third, the application material. It has been designated with the letter A. It provides context, explanations, suggestions for actions or matters to consider, along with other illustration and guidance to assist in complying with the requirements. As mentioned in the starting, the applicability of certain provisions of Volume 1, including that of NOCLAR, have been deferred till further notification. However, let's know what the NOCLAR requires. It refers to any act of omission or commission, intentional or unintentional, committed by a client or employer, including by management or by others working for or on the direction of the client or employer, which is contrary to the prevailing laws and regulations. NOCLAR was introduced to guide the PA in dealing with often difficult and stressful situations, as referred to earlier. It helps in deciding how to best serve the public interest in such circumstances. NOCLAR states that a potential NOCLAR shouldn't be avoided by the PAs and also places a renewed emphasis on the roles of the management and those charged with governance in addressing the matter. The ISBA Code of Ethics makes NOCLAR applicable to all assignments in case of members in practice and to all employees in case of members in service. However, in the ICAI code, as of now, the Institute has restricted the applicability of NOCLAR to audits only and to listed entities only. For the members in service also, the applicability has been restricted to the employees of the listed entities only. The application is limited for now since the NOCLAR is new to India, and the members must become conversant and comfortable while working with this feature. The members are expected to be conversant with the laws and regulations that have a nexus to their professional training and expertise. That is, the laws and regulations that have a direct effect in the determination of material amounts and disclosures in the financial statements, other laws and regulations, compliance with which may be fundamental to the entity's business and operations or to avoid material penalties. The first part is already a part of the compliance towards SA 250. Examples of laws and regulations required to be addressed are as under: fraud, corruption and bribery, money laundering, terrorist financing and proceeds of crime, securities market and trading, data protection, and so on. Please be informed that this is not an exhaustive list. It is also important to note that the accountant is not expected to have a level of knowledge of laws and regulations greater than that which is required to undertake the engagement. Let's see the other salient points about NOCLAR. Matters as stated below are not in the scope of NOCLAR. These are matters clearly inconsequential, matters of personal misconduct unrelated to the business activities of the client or the employer, matters of non-compliance other than by the client or the employer or those charged with governance or management or other individuals working for or under the direction of the client or the employer. It should be also noted that the professional accountant is required to address NOCLAR only and only when he encounters the same in the course of providing a professional service. He is not expected to be conversant with every law, investigate the compliance with all laws by the entity, be on the lookout for any non-compliance by the entity. It may also be noted that in a situation where disclosure ought to be made by the auditor, the appropriate authority for the purpose of disclosure will depend on the nature of the matter. For example, the appropriate authority would be SEBI in case of a fraudulent financial reporting. Appropriate alignment has been made in the code with regard to the requirement of confidentiality as required under the Chartered Accountants Act 1949. Let's understand the new term used in the code, that is the independence standards. While the 2009 edition of the code had section 290, that is independence assurance engagements, the volume 1 of the revised code based on the 2018 ISBA code has independence standards as under: Part 4A containing the independence for audit and review engagements, Part 4B containing the independence for assurance engagements other than the audit and review. These are characterized as international independence standards, as against section earlier. All the members are expected to comply with these independence standards while conducting the various professional assignments. It is noteworthy that the segregation of earlier section 290 into parts 4A and 4B represents the most bulky change, as the provisions or compliance are common to both parts 4A and 4B, but given separately in the code under both parts. The feature pertaining to unintentional breaches of the code as contained in section 400.80 to 400.89 of the volume 1 is a new provision. This may be said to be a mechanism of self-correction prescribed in the code in case the professional accountant on his own discovers an unintentional violation. These provisions mention the steps to be taken in case of breach of independence standards, that is, Part 4A and Part 4B. A PA who identifies a breach shall evaluate the significance of the breach and its impact on PA's ability to comply with the fundamental principles. As per the code, if a firm concludes that the breach of a requirement in this part has occurred, it shall take prescribed steps therein. For example, ending, suspending, or eliminating the interest that created the breach, considering an appropriate legal or regulatory requirement, and applying them. The term key audit partner was not defined in the ICAI Code of Ethics 2009. It has now been defined in the Volume 1 of the revised code as follows. A key audit partner is an engagement partner, the individual responsible for engagement quality control review, and other audit partners, if any, on the engagement team who make key decisions or judgment on significant matter with respect to the audit of financial statements on which the firm will express an opinion. Depending on the circumstances and the role of individuals on the audit, other audit partners might include, for example, audit partners responsible for significant subsidiaries or divisions. The term assumes significance in view of the fact that it has been used at many places in this code, which we shall see in the subsequent slides. Before we see the detailed provisions, let's first get an overview of the changes in the Volume 1 of the revised codes from earlier code with regards to the partner rotation. There is no change in the provision of 7-year time on in the revised code from the earlier code. The second change is that while the earlier code had flat 2 years of cooling off requirement, the revised code has changed the cooling off requirement for individuals engaging in the assignments as follows: 5 years cooling off for engagement partner in the firm, 3 years cooling off for engagement quality control review, 2 years cooling off for all other key audit partners of the firm. Time on period refers to the period where the member will keep working on the assignment as the partner of the firm. The cooling off period refers to the time period where he is required to not be associated with such assignment. This change is important as it makes stricter rules on partner rotation. The provisions of partner rotation are contained in Section 540 of the Volume 1 of the Revised Code of Ethics. Let's see the new incorporations in this regard. Under the Companies Act 2013, as per the provisions of Section 139, the partner's rotation is done on behest of the board of the company only, and it is not dependent on the firm to give effect to the partner's rotation. In case of companies where the members of the company prescribe a shorter time on period for the partners, such shorter time shall prevail as compared to the period prescribed in the Code of Ethics. Similarly, partner rotation requirements prescribed by certain regulators such as RBI, certain NBFCs, etc. shall prevail over the requirements mentioned in the Code of Ethics. There are certain restrictions on the activities during the cooling off period with respect to the partner rotation as contained in Section 540 of the Volume 1 of the Revised Code of Ethics. These restrictions are as follows. It has been prohibited to consult with the engagement team regarding technical or industry-specific issues, transactions, or events. It has been prohibited to lead or coordinate the professional services provided by the firm to the audit client or to oversee the relationship of the firm with the audit client. It has been prohibited to undertake any role or activity that would result in the individual having significant or frequent interaction with the senior management or those charged with governance, or exerting direct influence on the outcome of the audit engagement. The 2009 edition of the Code of Ethics contained the requirements relating to partners' rotation. It did not contain firm rotation requirements. The Companies Act 2013 stipulated firm rotation for the first time in India. The ISBA Code of Ethics 2018 has provisions of partners' rotation, but there is no provision for the firm rotation in the ISBA Code as well. In line with the Companies Act 2013, the Section 550 on firm rotation has been incorporated in the Volume 1 over and above the provisions of the partner's rotation appearing in the ISBA Code. Accordingly, it has been clarified in the code that the partner's rotation will coexist along with the audit firm rotation wherever prescribed by a statute. Thus, the 2019 code, that is the Volume 1, incorporates the firm rotation requirements to make the guidance comprehensive for the members. The provisions on management responsibilities occur for the first time in the ICAI Code of Ethics and appears in the sections 600.7 to 600.8 of the code. The feature did not find mention in the Code of Ethics 2009. However, in Volume 1, there is a new section dealing with management responsibilities. As per the same, the firm shall not assume a management responsibility for an audit client. Determining whether an activity is a management responsibility depends on the circumstances and requires the exercise of professional judgment. Examples of activities which would be considered as management responsibility would include setting policies and strategic directions, hiring or dismissing employees, directing and taking responsibilities for the actions of the employees in relation to the employee's work for the entity. However, providing advice and recommendations to assess the management of an audit client in discharging its responsibilities is not assuming a management responsibility. Providing administrative services to an audit client does not usually create a threat. Examples of administrative services include word processing services, preparing administrative or statutory forms for client approval, submitting such forms as instructed by the client, monitoring statutory filing dates, and advising an audit client of those dates. Members may note that there is another term known as management services as appearing in Section 144 of the Companies Act 2013. These are not defined in the Companies Act or rules framed thereunder. Since these will be defined by the government, there is no finality on the views of the management services being or not being at par with the management responsibilities as appearing in the Volume 1 of the new Code of Ethics. Let's now move on to the very important issue of providing non-assurance services to the audit clients as contained in the sections 600 and 950 of the Volume 1 of the Code of Ethics. The earlier prohibitions in 2009 Code on the provision of certain types of non-assurance services to audit clients continue in the revised code also. Specific non-assurance services are discussed in the subsequent part. Accounting and bookkeeping services are broadly like 2009 Code. These services are prohibited by the ICAI to the audit clients and also by the Companies Act to the audit clients. The Volume 1 contains the guidance on what constitutes as accounting and bookkeeping. Administrative services find new reference in the code. These services are permitted to the audit clients. These are now part of the MCS guidelines under Section 2, Subsection 2, Clause 4 of the CA Act 1949. Valuation services are broadly like the 2009 Code. These are the part of the MCS guidelines under Clause 15. Volume 1 prescribes threats and safeguards in providing the valuation services to the audit clients. Coming on to the internal audit services, the position is broadly like 2009 Code. These are prohibited by ICAI to audit clients and also prohibited in the Companies Act to audit clients. Volume 1 contains guidance on what constitutes as the internal audit. Provisions of services relating to information technology systems to the audit clients is also broadly like the 2009 Code. When providing these services, one shall ensure certain things like the client acknowledges its responsibilities for establishing and monitoring a system of internal controls. The litigation support systems is also broadly like the 2009 Code. Examples of these services are assisting with document management, acting as witness, and calculating estimated damages. The auditor should take safeguards if they provide litigation support services to an audit client and the services involve estimating damages or other amounts that may affect the financial statements on which the firm will express an opinion. Legal services are broadly like 2009 Code. These services might create self-review or advocacy threats. Partner or employee of the firm is not supposed to serve as a general counsel for the legal affairs. Corporate financial services are broadly like the 2009 Code as well. A firm shall not provide to the audit clients the corporate financial services that involve promoting, dealing in, or underwriting the audit client's shares. The firm shall not provide corporate finance advice to an audit client where the effectiveness of such advice depends on an accounting treatment or presentation of financial statement on which the firm will express an opinion. The audit team has a reasonable doubt as to appropriateness of the related accounting treatment or presentation under the relevant financial reporting framework, and the outcome of the consequences of the corporate finance advice will have material effect on the financial statements on which the firm will express an opinion. Some of the new prohibitions are applicable to recruiting services in Volume 1. These prohibitions are as on your screen. Enhanced general description of recruiting services, clearer guidance on types of recruiting services prohibited, new provisions to help avoid assuming management responsibilities when providing recruiting services similar to IT and internal audit. Prohibition on providing certain recruiting services now applies to all entities like searching for or seeking out candidates. Undertaking reference checks of prospective candidates has also been prohibited. Let's discuss the provision of taxation services to the audit clients. The applicability of this provision has also been deferred. Section 290.172 of the Code of Ethics 2009 pertained to the provisions of taxation services to the audit clients. It said that the taxation services to audit clients include compliance, planning, provision of formal taxation opinions, and assistance in resolution of tax disputes. Such assignments were generally not seen to create any threat of independence. Thus, in 2009, there was no prohibition on the taxation services to the audit clients. In the Code of Ethics 2019, Volume 1, there are certain prohibitions in the taxation services. Generally, it states providing tax services to an audit client might create a self review or an advocacy threat. Let's move to some specific situations. Usually, there is no threat in conducting tax return preparations. However, calculating tax for the purpose of preparing accounting entries that will be subsequently audited by the firm creates a self-review threat. The professional accountant has to see whether the calculation might have a material effect on the financial statements on which the firm will express an opinion or not. In conducting tax planning and other advisory services, it might create self-review or advocacy threats. In such a situation, appropriate safeguard needs to be adopted. For example, using professionals who are not audit team members to perform the service, having an appropriate reviewer not involved in providing services, reviewing the audit work, etc. Coming to the taxation services involving valuations, a firm or a network firm might perform a valuation for tax purpose only, where the result of the valuation will not have a direct effect on the financial statements. That is, the financial statements are only affected through the accounting entries related to the tax. However, the assistance in the resolution of tax dispute might create a self-review or an advocacy threat, and hence appropriate safeguards will have to be adopted in that case. Further, such assistance should not be provided at all if it involves acting as an advocate for the audit client or the amounts involved are material to the financial statements on which the firm will express an opinion. This slide discusses the safeguards taken by the members during the course of their engagement to address the threats to the fundamental principles. In the Code of Ethics 2009, safeguards were to be considered by the professional accountants for threats other than clearly insignificant. In the revised Code of Ethics, the new parameter is that the application of safeguards is required to eliminate the threats or to reduce them to an acceptable level. Acceptable level have been defined in the code as a level that a reasonable and informed third party, knowing facts, would likely conclude that an accountant complies with the fundamental principles. This, in short, is also known as RITP test. Such a party is non-existent and the professional accountant has to only presume that what will a reasonable third party do in such a circumstance. In the new code, the steps to address the threats are as under. Eliminate the circumstances creating the threats, apply safeguards, or decline or end the service. There is a new step back requirement for an overall conclusion. Requirement 120.11 says that the PA shall form an overall conclusion about whether the actions that the accountant takes or intends to take to address the threats will eliminate those threats or reduce them to an acceptable level. There is more emphasis that if the threats cannot be addressed, then the PA must decline or end the engagement. The use of terms close family and immediate family have been used at various places from the perspective of conflict. In Part A of the 2009 Code, close family and immediate family were replaced with the word relative as defined in Section 6 of the Companies Act 1956. In the revised Code of Ethics Volume 1, the above criterion has been changed. In the new code, for companies, relative of partners refers to the definition given under Section 2, subsection 77 of the Companies Act 2013. For clients other than companies, immediate family or close family as appearing in the ISB code is applicable. A close family is a parent, child, or sibling who is not an immediate family member. Immediate family is a spouse or equivalent or dependent person. The revised Code of Ethics contains a new term, public interest entity. It had not been used in the Code of Ethics 2009. A public interest entity is defined as a listed entity or an entity defined by the regulation or legislation as a public interest entity, or for which the audit is required by regulation or legislation to be conducted in compliance with the same independence requirements that apply to the audit of a listed entity. Such regulations might be promulgated by any relevant regulator, including an audit regulator. For the purpose of this definition, it may be noted that banks and insurance companies are also to be considered as public interest entities. Other entities might be considered by the firms to be public interest entities as set out in paragraph 400.8. There are enhanced independence requirements for public interest entity clients in the new code. For example, let us see the paragraph requirement 604.6 of the volume 1 of the revised code. It says that a firm or a network firm shall not prepare tax calculations of current and deferred tax liabilities or assets for an audit client that is a public interest entity for the purpose of preparing accounting entries that are material to the financial statements on which the firm will express an opinion. Let's move on to the issue of inducements, including gifts and hospitality, as contained in Section 250 and Section 340 of the Volume 1 of the Code of Ethics. In the Code of Ethics 2009, the offer of gifts or hospitality ordinarily seemed to give rise to threats to the fundamental principles. However, the significance of such threats depends on the nature, value, and intent behind the offer. If a reasonable and informed third party, having knowledge of all relevant information, would consider the inducement insignificant and not intended to encourage unethical behavior, then a professional accountant in service may conclude that the offer is made in the normal course of business and may generally conclude that there is no significant threat to compliance with the fundamental principles. If the threats are other than insignificant, he must take safeguards, and there is a total prohibition in case of assurance clients, except if inconsequential. The following changes are there in Code of Ethics 2019, Volume 1. Inducements have been elaborated over the 2009 edition. Now, it is the duty of the member to first see whether the things offered are prohibited by laws or regulations. Offering of gifts is also prohibited now. There is now a reasonable and informed third-party test to see whether it is with the intent to improperly influence the behavior of the recipient or of another individual. Clarifications about appropriate boundaries for offering and accepting the inducements have been also given in the new code, and this provision is extended to the professional accountant in service also. There is a total prohibition in case of audit or assurance clients, which remains the same from the 2009 Code of Ethics. Now, let's have a look on the requirements of documentation in the code. Documentation is the call of transparency. Paragraphs 290.27 of the 2009 code required firms to document their conclusions regarding compliance with the independence requirements. In the 2019 code, the requirements of documentation have been given in greater detail. Further, in NOCLAR, it requires all the steps in responding with the NOCLAR to be documented. The accountant is encouraged to document the facts, the accounting principles other than relevant professional standards involved, the communications and parties with whom the matters were discussed, the courses of actions considered, how the accountant attempted to address the matter. Requirements for NOCLAR has to be sufficient to enable an understanding of the significant matters arising during the audit, the conclusions reached, and the significant professional judgments made in reaching those conclusions. Thus, documentation is of critical importance in manifesting compliance with NOCLAR. Before proceeding with this provision, it may be clarified that this provision related to fees and its relative size under paragraph requirement 410.4 of the Volume 1 of the revised code has been deferred till further notification. As per this new provision in the revised code, where for 2 consecutive years the total gross annual professional fee from the audit client and its related entities represent more than 15% of the total fee received by the firm, then the firm shall disclose it to those charged with governance. However, no such ceiling would be applicable where such fee does not exceed Rs 5 lakhs. Further, no such ceiling would be applicable on the total fees of the firm in case of audit of government companies, public undertakings, nationalized banks, public financial institutions, or where the appointment of auditors are made by the government. This is technically not a restriction but a requirement to disclose. It may be noted that the condition of not having more than 40% fee from a single client is a part of self-regulatory of the Council as contained in the earlier code. This has been repealed as the provision of 15% has been adopted in the code. We have a provision for criteria of indebtedness contained in section 511.3A1 of the volume 1 of the revised code. It may be noted that there was no concept of materiality of loans and guarantee in the ISBA Code of Ethics 2005 and in the ICAI Code of Ethics 2009. However, the ISBA Code of Ethics 2018 introduces the concept of materiality of loans and guarantees. In determining whether such loan or guarantee is material to an individual, the combined net worth of the individual and the individual's immediate family members may be taken into account. The concept of indebtedness is mainly governed with the provisions of Chapter 10 of the Council General Guidelines 2008, read with other principle-based provisions contained in Part A of the Code of Ethics 2009. Paragraph 320 of the Volume 1 of the Revised Code of Ethics is a new provision which contains detailed guidance on the client and engagement acceptance or changes in the professional appointment. To supplement it with the relevant provisions, the ICAI's Know Your Client KYC guidelines have been incorporated in the code under this heading. These are mandatory to be complied with by all the members for all attest functions with effect from 1st January 2017. The revised code says that in case of change of appointment, if the incoming auditor is unable to communicate with the predecessor accountant, then he shall take all the reasonable steps to obtain the information about any possible threat. In the new code, communication requirements in case of audit and non-audit assignments are differentiated. These have been aligned with the requirements of Clause 8 of Part 1 of the first schedule to the Chartered Accountants Act 1949 and the commentary under the said clause. One of the new concepts is that there is a duty of the predecessor accountant to respond to the communication. He shall comply with all the relevant laws governing the request and provide any information honestly and unambiguously. There is no such corresponding duty on the predecessor accountant in the earlier Code of Ethics. Paragraph 290.197 of the Code of Ethics 2009 only said that the contingent fee is the fees based on the percentage of profit or contingent upon the findings or result of such work not allowed as per Clause 10 of Part 1 of the first schedule to the CA Act, except as permitted under Regulation 192. Volume 1 of the revised code does not change the said position. However, it gives a general description of the contingent fee and the general prohibition. The code further reproduces Regulation 192 of the Chartered Accountants Regulation 1988, that is the activities where the Council has permitted contingent fees. It notes the last entry to Regulation 192, that is, any other service or audit as may be decided by the Council. The code describes that the following activities have now been allowed under Regulation 192. These are charging of fees by members enrolled as insolvency professionals rendered either individually or as an entity under Insolvency and Bankruptcy Code 2016 and rules made thereunder, and fee for rendering non-assurance services to non-audit clients. Now you can see certain provisions in the Volume 1 of the new code which, though applicable to the members in service, may also apply to the members in practice. There was no corresponding feature in the earlier code. The revised 2019 code contains clear guidance for professional accountants in practice that while performing professional activities pursuant to their relationship with the firm, whether as contractors, employers, or owners of the firm, the relevant provisions with regards to professional accountants in service in Part 2 are applicable to them, that is, to professional accountants in practice also. For example, the provision in Part 2 would apply to an employee of a firm who is holding a certificate of practice. The provision of preparation and presentation of information as contained in Section 220 is new in the revised code. It provides a more comprehensive provision regarding responsibilities to be addressed by the PAs in service when preparing and presenting information. Also, it prohibits on exercising discretion when preparing or presenting information with the intent to mislead or inappropriately influence contractual or regulatory outcomes. There is now an enhanced guidance to assist the PAs in disassociating from misleading information. With this, we come to an end to our presentation. Thank you.